Hi folks, William Jordan here. Wanted to speak to you briefly today about the bond market bubble. If you have no bonds in your portfolio, no bond funds whatsoever, if you don't have a balanced fund, if you don't have a target retirement date type of fund, you can disregard this video because I'm just going to talk about the bond market for a couple of moments here today. But if you have any of those investments, whether it's individual bonds, bond funds especially, any of those other target date funds and such that add bonds into the portfolio, you need to hear and consider what we're talking about today. The bond market has enjoyed a 40-year bull market. Remember when interest rates were in double digits back in the late 70s, the early 80s? You were able to get CDs that were at 12, 14, even 16% in some cases. They had treasury bonds that were available for 14% for 30 years at one point in time. Imagine having a treasury bond for 14% for 30 years. Well, you go back and do that. Well, since that peak in interest rates, bond interest rates have been declining. And remember, bonds move, their prices move in opposition to interest rates. So when interest rates are at highs, bond prices are at lows. When interest rates are at lows, bond prices are at highs. So where are bond prices today? Where are interest rates today? Interest rates are still near all-time lows. Bond prices are near all-time highs. I've got a very simple question for you. Are interest rates likely to go up or down in the future? I assume you just said they're likely to go up. Because yes, interest rates could keep going down. I mean, we aren't at zero yet. We're getting pretty close, but we're not quite there. So they could keep going down, but there's not a lot of room for them to go down much further. There's a tremendous amount of room for interest rates to go up, meaning there's a tremendous amount of room for bond prices to fall. Bonds are the next big bubble that's going to pop in the investment world. You know, we had the real estate bubble that popped back in 2008. We had the subprime mortgages. We had the stock market bubble, the internet bubble that popped in the end of the 1990s, early 2000s. And we could go back throughout history and talk about all the bubbles. What happens is you have an investment that does so well for so long that people forget that there's risk associated with it. And that is the point with bonds right now. So if you have bonds in your portfolio, this is a warning call that you seriously need to consider getting rid of those bonds as soon as possible. Now, I understand everybody's situation is different, and so there are scenarios that you could argue that some bonds might fit, but I'm really hedging on that because bonds move in opposition to interest rates. So one of two things is going to happen. Interest rates are either going to stay low, in which case your yield is lousy, or interest rates are going to rise, in which case your yield will slowly climb, but your prices are going to fall. There's a lot of risk there. And there's more risk in a bond fund than there is in an individual bond, though there's still risk there, and I'll mention that in a moment. But in a bond fund, the risk is almost magnified because think about what happens. First off, interest rates are low. What do people do when bond prices are high and interest rates are low? Bond prices are high, they pour money into bond funds because, hey, this has been a good investment, it's been safe, the yields have been outstanding, low risk, I want to diversify away from the stock market, push money into bond funds. They think they're getting something that's different than what they're really getting. But now you're the bond fund manager. You've got all this cash coming in, and what is your job? Your job is to take that cash and invest it in bonds. So you're buying bonds. Where are you buying them? You're buying them at all-time high prices. Low yields, all-time high prices, worst possible time to buy bonds, and yet everybody's sending you a check every single day. Now think about the bond funds and the manager and the investors when interest rates start to rise and prices start to fall. What's going to happen is you're going to start getting liquidation requests. Somebody sees a little movement down in their statement, thinks, I thought this was safe, I'm going to go ahead and take my money out. So as prices start to fall, bond managers are going to start selling their bonds to meet the redemption requests. So instead of doing what we'd like and saying, hey, interest rates are coming up, let's buy more bonds and start trying to move up our interest rate we're earning, what are they doing? They're actually starting to sell. And the more bond prices fall, the more bond fund managers have to sell, and that whole trend is really going to be pushed like that snowball rolling down the hill. The problem there is those clients are going to call, cash out their bond fund holdings, and it's going to happen more and more and more, and you could see massive collapse in value in bond funds. I'm not talking about bonds defaulting and going to zero. I'm just talking about the prices dropping significantly. I'm going to say this, and it's a very strong statement, but I really do stand behind this. If you have a bond fund in your portfolio, it is probably the wrong investment in this environment. You prove me wrong. Send me your bond fund information. We will look at it and we will send you a response on the bond fund that you're invested in and how we think it's going to do, why we think it could do that. The ones that will hold up the best are the bonds that have the shortest maturity. Because think about, I talked about prices and interest rates moving in opposition. Think about a teeter-totter and the swings. The further you are out on the teeter-totter, and I'm using time right now, so a long-term bond is going to swing more in value up or down than a shorter-term bond. It doesn't have as far to go. So as interest rates start to rise and prices fall, a short-term bond isn't going to fall that much in price because it's short-term. It's going to come due, that money can be reinvested in something at a different rate, so the price doesn't move as much. If you've got 20, 30-year bonds out there, those prices could be hammered. And again, in a bond fund, it's going to be even worse. You can look at the average maturity of your bond fund to get a feel for that. So keep in mind, not only are you having all those problems, but by the way, you're paying that bond fund manager to manage for you. They're going to do the best they can, but you really do need to be concerned. Now, a brief word about individual bonds, and then I'm going to thank you for your time today. Many people I've spoken with over the last few years have said, William, I hear what you're saying, but you don't have to worry about me. I have individual bonds. And individual bonds come due at their par value, so I can't lose money. That's true and false at the same time, and here's what I mean by that. What's true is that bonds come due at their par value. So at the day of maturity, that bond is typically worth $1,000 per bond. Now there's two ways that you could lose money in spite of that fact being true. First way, what is the bond worth today? Take out your statement and look, and what price is there on the bond? Most bonds today are trading at a premium, meaning they're worth more than that $1,000 per bond. If you could sell your bond today for $1,050, there's $50 that you will lose between now and the time your bond comes due. That's a guaranteed loss. There's no way around it because you own the bond at a higher price today and it's going to come due, mature, at a lower price. So that's the first loss that you will experience. Then there's a second loss that you should be aware of, though you may be able to avoid it if you hold the bond to maturity. And that is the price fluctuation. The bond could go from $1,050 today, it could be worth $950 in a year from now. And I'm just hypothesizing numbers here, I'm not quoting any specific bonds, but to give you the point. Because the bond comes due at $1,000 doesn't mean it can't be worth less than $1,000 at some point in that time period. So you could see a bond that's trading at $50 above, trade at $50 below or more, depending on the bond, depending on the maturity, depending on the coupon rate. And when you look at your statement and it says you have $200,000 in bonds, and then the next quarter your statement says you have $180,000 in bonds, it's not going to do you much good at that moment to think, well, I can hold to maturity. What if you needed the money before then? What if you just didn't like seeing the loss and you chose to sell out? What if a number of things? You can hold to maturity, but if you're going to hold to maturity, you need to be able to answer this question for me. And this is kind of a aha, in a sense, but this is going to make a lot of sense. It'll be very clear to you. You need to know one number, not your coupon rate. If I had $1 for every time somebody told me, oh, William, my bonds pay 6%, they're great, I don't want to sell my bonds, and then I find out that they're not earning that, I'd be a rich man because of that. Here's the number you need to know. You need to know what's called yield to maturity, YTM. Now, I would argue that yield to maturity in today's environment is the most important number as it relates to a bond. And most of you, I think, will agree with me because yield to maturity is the actual annual average rate of return you would make from today until that bond comes due. So remember, some of you said, I'm not going to lose money because I'm going to hold to maturity. Okay, what is my yield to maturity? Your yield to maturity is not the coupon rate. But here's the problem, and here's where our industry can really get me mad sometimes. Go to your statement. Now, if yield to maturity is the most important number, you'd expect it to be prominently listed on your statement, right? It is not. In fact, in most cases, yield to maturity no longer appears on investment statements. Why is that? And forgive me for getting a little bit skeptical here and getting up on my high horse and standing up on my pedestal and banging my fist, so to speak. But what is our industry doing taking yield to maturity off of your statement? That was unreasonable and ridiculous. But why was it done? Because they know if you look at that yield to maturity and you see that your 6% bond is going to pay you 2.1% yield to maturity, you're going to sell and you're not going to be very happy. And so in their own best interest, they took yield to maturity off the statement. That disappeared from most of your statements about 4 or 5 years ago. If you still have a company where you hold bonds and they put yield to maturity on your statement, I commend that company. They have good integrity. They are putting all that information out there. It's the information you have a right to in order to know your numbers. If it's not on your statement, you need to calculate it. Now, we do bond reviews for clients, so you could send us a bond portfolio. We'll calculate yield to maturity for you on each bond. But there's online calculators that you could use to do this very simply. You put in the maturity date of the bond, you put in the coupon rate of the bond, you put in the current price of the bond, and it will calculate and tell you what your yield to maturity is. You need to know that. When I go through a portfolio of bonds today, I usually find yield to maturities that are anywhere from 1 point something small to, in some cases, as high as 4 point something. A 4 point something bond is decent. If you have a 1.2% bond and it's a 10-year bond, or heaven forbid, what if you have a bond that's 1.2% yield to maturity and it's a 20-year bond? You're telling me you've made the decision to own a 1.2% investment that's locked in for 20 years. And remember, since that value can decline more in the short term than the maturity date, what if you lose money and then decide, forget it, I'm not going to hold this thing for 20 years, and then you actually sell? So right now you're taking all of the risk with very little reward. You've got a feel for why I've really been harping on this issue. I've written about it, I've spoken on it, it's talked about in my book, talked about in several of my books, and I'm sending this out to you today so that you have a better understanding of why bonds are the next big bond bubble. If I'm wrong, then you can have your lousy interest rates that you're earning on bonds. But folks, if I'm right, you're going to lose money in what is supposed to be your safe investment. Now, the problem that financial advisors really run into is when you tell them the bonds are the wrong place to be, they kind of generally will agree, but they're a little bit stuck with, well, I'm not sure what else to put your money in. That's an area that we can really help because we have more asset classes that we work with. I talk about that in another video, so you can always take a look at that at a different time. But feel free to call us and work with somebody in our office. We'll give you a second opinion on what you're doing with your money and help make sure that if you are going to hold bonds or, heaven forbid, bond funds, that you at least have all of the information. I don't ever want you to feel like nobody told you or you didn't know. So we think that the best thing we can do for investors is equip them with information. Information is going to help you to make the right decision. I want to thank you for your time, and I wish you all the best of success in investing. Thanks.